What if I told you everything you think you know about the stock market might be wrong? That crash everyone's fearing isn't some random glitch. It's built into the system on purpose. We're living through the longest, wildest bull market ever, and by every old school metric, like history or textbooks, it should have collapsed ages ago. Yet here we are, prices still climbing, breaking records, and leaving investors scratching their heads. Take the Buffett Indicator, Warren Buffett's go-to tool. It compares total stock market value to the US GDP. Right now, with a $66 trillion market cap against a $30 trillion GDP, we're at 216%, way past the 115% that signaled the dot-com crash in 2000. That crash wiped out portfolios. Today's numbers suggest we should be in ruins, not riding high. Even the top S&P 500 companies have crazy price-to-earnings ratios around 66. Imagine paying $66 for a $1 hamburger. Normally, 15 to 20 is healthy. 66 is off the charts. And smart money, like Buffett, he's sitting on cash, not buying, which screams danger. Okay, just letting you know, I talk about global politics every day, so subscribe to not miss out. So why hasn't it crashed? Because the game's changed. It's not a free market anymore. It's a controlled setup. The old cycle of boom, greed, and bust is broken. Smart players aren't dumping stocks, they're holding steady. This hints at a system designed to extract wealth, not reflect reality. The fuel? Massive government spending, $7 trillion a year, with $2 trillion borrowed, pumps money into corporate profits, propping up stock prices. Plus, geopolitical moves to keep US dominance and a bet on dollar devaluation keep it afloat. Investors aren't betting on growth, they're hedging against a sinking currency. But it's not just fuel, it's rigged mechanics keeping this alive. Take quantitative easing, or QE. The Fed prints money to buy bonds, inflating asset prices for the top 5% who own most of them. Banks front-run these buys for guaranteed profits. Then there's controlled crashes, like 2000, 2008, and 2020, where insiders sell high, trigger a dip, and buy back cheap after bailouts, leaving regular folks with losses. High-frequency trading and secret dark pool exchanges let big players skim billions, while the market you see on TV is just a show. This setup creates a wealth gap on purpose. The top 10% get richer as asset prices soar, while the rest feel it as higher grocery bills and rent. Pension managers know it's a house of cards, but can't sell out without losing their jobs. Media and academia back this up, spinning complexity to keep us confused and divided, never questioning the Fed's power. So when will it crash? Not when the market breaks, when breaking it benefits the controllers. It could be foreign creditors demanding real assets, social unrest from squeezed families, or young people rejecting debt. The crash will be strategic, not economic. And when it hits, the connected will profit while the rest pay. This isn't a bug, it's the system's design.